I've been asked to speak on financial services, liberalization of financial services. Well, this is a bit of a problem because of the fact that there is an incongruity of looking at financial services in the context of WTO in general and Nairobi in particular. Because if you look at the extent to which within the multilateral framework liberalization has proceeded in the financial services area, actual liberalization on the ground in most developing countries is far ahead of whatever few commitments have been made as part of the sort of the larger GATS request and offer process in the financial services area. Now, why is this? Why this is essentially because of the fact that if we go back to the early 1970s, there were two things which were happening. One, of course, developing countries which up till that point of time could not access foreign exchange or foreign capital other than through the direct foreign investment route, where people came and established productive capacities in developing countries, or through the route of bilateral and multilateral aid, either through the Bretton Woods institutions like the World Bank or the IMF, or through bilateral donors. That this essentially meant that for a long period of time, how much capital flowed into developing countries was determined from the supply side. It depended upon the decisions of foreign investors, whether they wanted to come and service your markets or use you as a base for world market production, or it depended on the interest of particular governments, either through their participation in multilateral agencies or bilaterally, to provide you with aid, and which of course was a political decision. In particular, it was related to colonial histories. I mean, colonial countries which were the imperial countries preferred to give aid to their own colonies. So we were in such a world, and whereas if you looked at it in terms of private flows of capital, there were hardly any private flows of capital of any significance, excepting to one or two countries like South Korea, which had the backing of the United States, given the fact that it was a frontier country in the sort of conflict between capitalism and socialism. Now, given that, what you actually had is that you had a long period of time when developing countries actually operated with quite stringent controls on the flow of capital into their domestic tariff areas, because of the fact that in any case, if they liberalized those conditions, they would not get access to much foreign exchange flow, since the private foreign financial market thought these countries to be too risky, both in a political sense and in terms, economic sense, particularly the possibility of exchange rate devaluation, because these countries were seen as too risky. That changed in the 1970s. It changed in the 1970s for a number of reasons. From the supply side, that is, from the point of view of the developed countries, whose wealth was largely mediated through two major financial centers, which was the City of London and New York. All of it was mediated through these two centers, and to a certain extent Frankfurt, that you saw a substantial accumulation, and I'm not going to go into the reason why, a substantial accumulation of liquidity in the financial system, in particular the banking system. That is, now banks were loaded with liquidity, and more so after the two oil shocks, when the oil surpluses also got deposited in the international banking system, and therefore they needed to find new areas to which they can lend and in which they could invest. The second, of course, is that by that time, the United States in particular had begun to lose its competitiveness in manufacturing, in the production of goods, and therefore there was a conscious effort to try and move into services. So they wanted a liberalization of services in the international market, and of course one of the services in which they had a distinct advantage was financial services. And as far as the developing countries was concerned, if this actually did happen, that there would be a substantially increased flow of private financial capital to developing countries, they would get access to foreign capital to a much larger extent than they did in the past. And this, particularly given the failure of import substituting industrialization, gave them a degree of maneuverability. They could actually try and relax the constraint which a sort of lack of access to adequate foreign exchange, the success with exports actually meant. So therefore, starting from that period, there's been this process of liberalization, and what we've actually seen is that this liberalization has resulted in a situation where very quickly, if you, for example, take structural adjustment programs, If you take the 1960s or earlier, in adjustment programs, you rarely saw a financial component. But from these late 70s and 1980s onwards, starting with the Southern Cone countries in Latin America, financial liberalization became an important part of structural adjustment packages, and soon what are called FSAPs, that is financial sector assessment programs, became almost a necessity for all developing countries which were looking for some form of balance of payment support or aid from the multilateral agencies. So therefore, over a period of time, partly because of the pressure which was exerted and partly by the Bretton Woods institutions and the developed country governments, and partly because of the desire of these developing countries themselves to open borders and try and attract foreign capital, which gives them some maneuverability, we saw a process launched which involved a significant degree of liberalization on two fronts. First, cross-border flows of capital, or the lifting or gradual dilution of capital controls, and second, liberalization of rules for the entry and operation of the carriers of capital, of foreign firms which carried the foreign exchange to your domestic tariff areas, whether they be banks, insurance firms, or other kinds of firms. We began to see a process of liberalization. It came later in India, but it had come to many developing countries starting from the late 1970s and going through the 80s. Now, if that is the case, why is WTO important? And, well, you know that there are two things which liberalization involves. So one, of course, it involves market access, in the financial services area. In other areas, it involves more. And market access basically means that one, you want the freedom to be able to move capital across borders without much difficulty and high taxation. And two, you want access in terms of being able to establish a commercial presence, that institutions like banks, insurance companies, etc., want a commercial presence in your area. But the point is, if you do provide them this, but on the other hand, you try to regulate them very strongly. You try to say that, listen, we're going to limit the number of banks which will be given licenses. We're going to limit the number of branches which could be established. We're going to cap the equity which foreign investors can hold, etc. That actually doesn't give them the kind of field of operation which they'd like. So the second area of debate is on on domestic regulation. You not only want access, but you want diluted domestic regulation. And the third, of course, is that diluted domestic regulation, they want to be accompanied by a harmonization in terms of prudential regulation. There is norms with regard to accounting standards, disclosure, etc. And Basel norms, which are not constituted or put out by an organization which functions on the basis of treaty, but it basically was set up by a bunch of central bankers from the developed countries who met and decided that they have to create global rules. You want the implementation of these global rules or forms of it in each of the developing countries such that you have harmonized market regulation. This is the push, but the push really doesn't occur through the WTO in the first instance. Because of the fact that this liberalization process has continued for long, what we see is that in a large number of bilateral, plurilateral treaties, including, of course, now in areas, things like the Trans-Pacific Partnership, etc., there is an effort to try and create a template of the amount of liberalization that you should have, of the degree to which governments can intervene to regulate, and of the possibility of having some degree of flexibility of changing things once you've accepted a certain commitment. And the base commitment is, when you enter into these treaties, it's always argued that the minimum you should provide is where you are in terms of current liberalization. This essentially means that earlier you did liberalize, but that was choice. So you had the choice of going back. But if you take that liberalization as the base on which you create a template, and the template is actually stating that the minimum you should actually provide is where your liberalization is at, and you should offer new commitments, additional commitments, and there is a standstill clause. Once you make that commitment, then you actually cannot go back on it. What you want to do is bind people into maintaining these liberalizations, which have many consequences which I'm not going to go into in terms of external stability, in terms of internal possibility of internal crisis, in terms of credit squeeze, etc. Now, just to sort of come to the end of this, so once you get into this trajectory where there is this standstill and a pressure to, what you actually have is a situation where countries, including the United States, by the way, including the United States, because a lot of things which are part of Dodd-Frank, the Dodd-Frank Act, which came into operation after the crisis, would actually violate a number of a number of sort of clauses which United States has entered into treaties which it has had with a number of countries. But anyway, the basic point which happens is that you are under pressure then to not merely accept these, but you are not in a situation of crisis, you don't have any safeguard mechanism. This obviously undermines the legitimacy of these kinds of treaties. What you want the WTO to do is really in the financial services area, that going beyond GATS, because you actually, if you look at it, the Uruguay round had 2 annexes. It had a GATS treaty, but it also had 2 annexes relating to financial services. So going beyond that, you want it to be included in a multilateral framework, not because of the fact that that is going to help you push this further, but it's going to help you consolidate, push it further, ensure standstill, and give it a legitimacy, because now a one country, one vote body is going to actually provide the sort of the site in which all this is going to be sort of legitimized. Finally, the last danger which I think we should recognize is that as this is going, if you begin to look at those templates, an interesting phenomenon is that in TPP, for example, you moved in financial services areas, as in other areas, from dispute settlement mechanisms which are state to state to dispute settlement mechanisms which are between investors and states, the investor-state dispute settlement mechanisms. And once you do it, you're basically saying extrajudicial tribunals set up, and we know what happened in the case of Argentina, even when it went through a judicial process in the United States, are going to be responsible for deciding when you violate or flout a norm, and therefore would be subject to penalties which involve huge compensation. Thank you.